There's a piece of paper in your wallet right now that has no gold behind it, no oil reserves backing it, and technically nothing forcing anyone on Earth to accept it. And yet, it's the most powerful object in the global economy. When Russia wants to sell oil to China, they use it. When Japan buys goods from Germany, they use it. When a coffee farmer in Colombia gets paid, when a tech company in India raises money, when literally any major transaction crosses a border anywhere on this planet, there's about an 88% chance it happens in US dollars. Not rubles, not yuan, not euros, dollars. But here's the thing nobody tells you. This wasn't inevitable. It wasn't some natural law of economics. The dollar didn't become the world's default money because it was the best currency or the most stable or backed by the most resources. It became the default because of a very specific sequence of events that happened over the course of about 30 years. And most people have no idea how it actually went down. So let's talk about how a country that represents less than 5% of the world's population ended up controlling the financial operating system for almost everyone else. Because once you see how it happened, you start to notice something uncomfortable. The whole thing is way more fragile than it looks. Here's why this matters right now, today, in a way that actually affects you. Every time you hear about inflation, interest rates, sanctions, trade wars, or countries trying to de-dollarize, what you're really hearing about is this system, the dollar standard. And it's under more pressure now than it's been in 50 years. China and Russia are actively trying to trade without it. Saudi Arabia is flirting with selling oil and other currencies. The BRICS nations are talking about creating their own alternative. Even France, an ally, has openly called the dollar's dominance a problem. And if that system cracks, if the dollar loses its spot as the world's reserve currency, it doesn't just hurt America. It reshapes everything. Exchange rates, import prices, your purchasing power, the interest rate on your mortgage, the stock market, global stability. This isn't abstract economic theory. This is the architecture underneath the entire world economy. So how did we get here? Let's rewind. July 1944. World War II is still raging, but the Allies know they're going to win. And they have a problem. The last time a major war ended, after World War I, the global economy collapsed into chaos. Currencies became worthless. Hyperinflation destroyed savings. Trade broke down, and 20 years later, the world was at war again. So before this war even ends, delegates from 44 countries meet at a resort in Bretton Woods, New Hampshire, to design a new system. They want to create stable exchange rates, predictable trade, and most importantly, avoid another economic meltdown that leads to another world war. The question on the table, what should international money be based on? For most of human history, the answer was gold. Gold was scarce, portable, universally valued. But there's a problem with gold. There's not enough of it. If your economy grows faster than your gold supply, you get deflation. Trade seizes up. It's restrictive. Plus, after 2 world wars, most countries are broke. They've spent their gold. Their economies are shattered. They need something more flexible. Enter the United States. At this point, America has about 2/3 of the world's gold reserves. It's the only major economy that didn't get bombed into rubble. It's producing half of the world's manufactured goods. It's the undisputed economic superpower. So the US makes an offer. Here's the deal. We'll tie the dollar to gold at a fixed rate, $35 per ounce. And we'll let any foreign government exchange their dollars for gold at that price anytime they want. In return, every other currency will peg to the dollar. It's elegant. You get the stability of gold without the inflexibility. Countries can trade in dollars, knowing they're backed by gold, without physically moving gold bars around the world every time someone buys something. The dollar becomes the middleman, the universal translator for global trade, and it works. For about 25 years, this is the system, the Bretton Woods system. It creates the most stable period of economic growth in modern history. Global trade explodes, currencies hold their value. Everyone trusts the arrangement, but there's a hidden time bomb ticking inside this machine. Here's the flaw. The US promised to exchange dollars for gold at $35 an ounce, anytime, for anyone. But it kept printing dollars. At first, this wasn't a problem. The world needed dollars to rebuild, to trade, to grow. And the US had plenty of gold to back it up. But by the 1960s, something started to shift. The US was spending heavily. The Vietnam War, social programs, foreign aid. The economy was growing, but so was the money supply. Dollars were flooding the world faster than gold was sitting in Fort Knox. And some countries started to do the math. France, under Charles de Gaulle, was the first to call it out. De Gaulle looked at the system and said, wait a second. America is printing money, buying our goods, building military bases in our countries, all with paper that's supposedly backed by gold. But what if there's not enough gold? So France did something bold. It started exchanging its dollars for gold. Not as a hedge, as a test. And it worked. The US had to hand over the gold. Other countries noticed. They started doing the same. Germany, Switzerland. The trickle became a flood. By 1971, the US gold reserves were dropping fast. And the math was getting uncomfortable. There were way more dollars circulating in the world than there was gold to back them up. If everyone showed up at once asking for gold, the system would collapse. The promise was impossible to keep. So on August 15th, 1971, President Richard Nixon went on TV and did something unprecedented. He announced that the U.S. would no longer exchange dollars for gold. Just like that, he closed the gold window. The Bretton Woods system was over. And here's the twist. The dollar didn't collapse. It got stronger. Now, you'd think that when the U.S. broke its promise, when it admitted there wasn't enough gold to back the dollars it had printed, the world would lose faith in the currency. But that's not what happened. Instead, the dollar went from being backed by gold to being backed by something even more important: oil. Let me explain. In 1973, the U.S. was dealing with a massive problem. It had just come off the gold standard. Inflation was rising, the economy was shaky, and the Organization of Petroleum Exporting Countries, OPEC, had just launched an oil embargo that sent energy prices through the roof. The U.S. needed to stabilize the dollar, and it needed leverage over oil. So the Nixon administration, and later the Ford and Carter administrations, made a series of deals with Saudi Arabia and other oil producers in the Middle East. The deal was simple. You sell oil exclusively in U.S. dollars, and in return, we'll provide military protection, weapons, and political support. Saudi Arabia agreed. So did most of OPEC. And just like that, the dollar had a new anchor. Think about what this means. Every country on earth needs oil. To get oil, you need dollars. To get dollars, you need to sell something to someone who has dollars, which usually means trading with the U.S. or someone in the dollar system. The dollar wasn't just a currency anymore. It was the entry ticket to the most important commodity on the planet. This is the petrodollar system, and it changed everything. Countries started holding dollars in reserve, not because they loved America, but because they needed dollars to buy energy. Central banks stockpiled U.S. Treasury bonds. Global trade invoiced in dollars. The financial system recentered around New York. And the U.S. got something incredible: the ability to print money and have the rest of the world absorb it. Here's how that works. When you or I print fake money, we go to jail. When the U.S. government prints dollars, the world uses them. This is what economists call exorbitant privilege, and it's one of the most powerful and underappreciated advantages any country has ever had. Here's the mechanics. Because the dollar is the global reserve currency, there's always demand for it. Countries need dollars to trade, to hold in reserves, to pay off debts. That demand is structural. It's baked into the system. So when the U.S. runs a deficit, when it spends more than it takes in, it doesn't face the same consequences other countries do. It just issues more treasury bonds, and the world buys them because those bonds are denominated in dollars and everyone needs dollars. It's a closed loop. The U.S. can borrow at lower interest rates than anyone else. It can run trade deficits year after year without facing a currency crisis. It can sanction other countries by cutting them off from the dollar system. And that sanction has teeth because being outside the dollar system means being outside the global economy. It's not just economic power, it's geopolitical leverage. But here's the uncomfortable part. The system only works as long as everyone believes it will keep working. The dollar has no gold backing it. No commodities, no physical anchor. It's backed by trust. Trust that the U.S. will remain stable, that it won't print too much money, that the system won't fall apart. And that trust isn't guaranteed. For decades, the system held. But over the last 10 years, something has shifted. Countries are starting to ask a dangerous question. What if we didn't use the dollar? It started quietly. In 2014, Russia was hit with sanctions after annexing Crimea. Those sanctions cut Russian banks off from the dollar system. It hurt, and Russia started looking for alternatives. China was watching. China's economy had exploded, but it was still dependent on dollars for trade and reserves. That dependency felt like a vulnerability. So China started pushing the yuan as an alternative, setting up currency swap agreements, creating payment systems that bypassed the dollar. Then other countries joined in. India and Russia started trading in rupees and rubles. Brazil and China started settling trade in yuan. Saudi Arabia, the cornerstone of the petrodollar system, started talking openly about accepting yuan for oil. Even U.S. allies are hedging. Europe has tried to create payment channels that avoid U.S. sanctions. Central banks around the world are buying gold again, diversifying reserves away from treasury bonds. The motivations vary. Some countries are trying to escape U.S. sanctions. Some want monetary independence. Some just don't trust the U.S. to manage the dollar responsibly, especially after the 2008 financial crisis and the massive money printing during COVID. But the result is the same. The dollar's dominance is being tested in ways it hasn't been since the 1970s. Now, here's the reality check. De-dollarization is harder than it sounds. The dollar isn't just a currency, it's infrastructure. The SWIFT payment system, the network of correspondent banks, the legal frameworks, the liquidity, the depth of U.S. financial markets, none of that exists for the yuan or the rupee or the real. Switching off the dollar isn't like switching apps on your phone. It's like trying to replace the electrical grid while the power is still on. But the fact that countries are trying tells you something. The system that seemed permanent 30 years ago now feels contingent. So let's talk about what actually happens if the dollar loses its reserve status. Not in some dramatic overnight collapse. That's not how these things work. But slowly, over years, If global trade starts shifting to other currencies, if central banks dump treasury bonds, if oil gets priced in yuan or a basket of currencies, what does that look like? First, interest rates go up. Right now, the US borrows cheaply because the world wants dollars. If that demand drops, the US has to pay more to attract buyers. That means higher rates on everything: mortgages, car loans, business credit, government debt. The cost of borrowing rises across the board. Second, inflation becomes harder to control. Right now, when the US prints money, a lot of that money gets absorbed overseas. It's used in trade, held in reserves, stashed in foreign banks. But if the world doesn't want as many dollars, that money stays in the US economy. More money chasing the same goods, that's inflation. Third, the trade deficit becomes a real problem. Right now, the US imports more than it exports, and it pays for that deficit by printing dollars that other countries are willing to hold. But if they're not willing to hold dollars anymore, the US either has to balance its trade or see its currency weaken. A weaker currency makes imports more expensive. That's also inflation. Fourth, geopolitical power erodes. The ability to sanction countries, to freeze assets, to control access to the financial system. That power comes from the dollar being essential. If it's not essential, those tools stop working. And fifth, the global economy becomes less stable. Like it or not, the dollar system created predictability. Everyone knew the rules. If that system fragments, if every region has its own currency block, trade gets more complicated. Volatility increases, uncertainty rises. None of this happens overnight. But it doesn't have to. Even a slow drift away from the dollar reshapes everything. Here's the irony. The US benefits enormously from the dollar being the reserve currency. But that status also creates a trap. Because the world needs dollars, the dollar stays strong. A strong dollar makes US exports expensive and imports cheap. That's great if you're buying stuff, but it guts domestic manufacturing. It creates trade deficits, it hollows out industries. So the very thing that gives the US economic power also undermines its industrial base. And there's a deeper contradiction. To keep the world supplied with dollars, the US has to run deficits. It has to send more dollars out than it takes in. That's how reserves get built up overseas. But running endless deficits creates debt. And at some point, that debt becomes unsustainable. It's a system that requires imbalance to function. An imbalance, by definition, can't last forever. The French economist Valéry Giscard d'Estaing called this the exorbitant privilege, but his advisor, Jacques Reff, had a different name for it, the exorbitant burden. Both were right. Zoom out for a second. The story of how the dollar became the world's default money isn't really about currency. It's about power. It shows how a financial system can be just as important as a military, how trust can be weaponized, how architecture, the invisible rules and systems everyone takes for granted, can matter more than resources. The dollar didn't win because it was backed by the most gold or the biggest economy. It won because the US built a system where everyone else had to use it. And once that system was in place, it became self-reinforcing. But it also shows how fragile these systems are. Bretton Woods looked permanent until it wasn't. The Petrodollar system looked unshakable until countries started looking for exits. Every empire, every dominant power eventually faces the same problem. The tools that made you powerful become the constraints that limit you. The systems you built to serve your interests start serving themselves, and the world quietly starts building alternatives. We're watching that happen in real time. Is the dollar's dominance ending or just evolving? Some people think the system is collapsing, that we're witnessing the slow motion decline of American financial hegemony, the same way Britain lost the pound sterling's dominance after World War II. Others think it's overblown, that the dollar is too embedded, too useful, too liquid to replace, that every alternative has bigger problems. The yuan isn't freely convertible. The euro has political fragmentation. Bitcoin is too volatile, gold is too restrictive. Maybe they're both right. Maybe the future isn't a single reserve currency, but a multipolar system where the dollar, yuan, euro, and digital currencies all coexist, more fragmented. Less stable, but also less concentrated. Or maybe the dollar hangs on for another 50 years, because inertia is a hell of a drug, and replacing the global financial system is harder than anyone thinks. Here's what we know for sure. The dollar didn't become the world's money by accident. It became the world's money because of specific decisions, made by specific people, at specific moments in history. Gold standard Bretton Woods, Nixon shock petrodollar deals, and systems built by decisions can be undone by decisions. The dollar's dominance was never inevitable, which means its future isn't either.